So to start off with, I'm going to do a little overview of the entities that we typically see in the business world. We see an awful lot these days of limited liability companies. And limited liability companies are very flexible. They have a great, a wide range of applicability across a lot of different entities and industries and businesses that your clients may be considering. A limited liability company, it's a fictitious entity that's created by state statute. There's no federal statute dealing with limited liability companies. It's all under state law. And as the name says, the main thing is that they provide limited liability for the owners and for the people who are operating the business, who are often called managers. Corporations offer limited liability as well. Corporations have been around for a very long time. LLCs have only been around really for about the last 20 years or so in common practice, and in some states even more recently than that. But corporations have been around forever. They're very well established, very well known, and again, they are creatures of statute. You have to look to the statute of the particular state where you're thinking about forming a corporation to see exactly what you have to do and what information you have to provide in order to form the corporation. S corporations are exactly the same as regular corporations. There's a lot of misconceptions out there among people who are not experienced practitioners who are concerned that S corps, don't have limited liability or that there are some drawbacks to them. That's not true. As long as you can meet the IRS requirements to be an S corporation, you get the exact same protections that you get from an ordinary C corporation. You just get a different tax treatment. And as we'll talk about later, that requires you to make some filings and to do some affirmative things. We're also going to talk a little bit about partnerships. We don't see partnerships as often these days in the business world. 40 or 50 years ago, they were very common entities. They were very frequently used for many more things than they are today. But as the LLCs have come into being, as more and more states adopted LLC statutes and they became more broadly used, partnerships have sort of gone away. And there's a lot of different partnerships. There's general partnerships, there's limited partnerships, there's limited liability partnerships. Where you do tend to still see these is in the professional entities arena, for accountants, for attorneys, for other professional organizations that by statute can't be a corporation with complete liability protection. So partnerships have a fairly limited universe in which they're used. We don't see them as much anymore, and you certainly don't want to be a partnership for any type of entity that's going to be an operating business, a retail business, or a manufacturer. Lastly, we'll hit on sole proprietorships a little bit. A sole proprietorship is really nothing more than a doing business situation where somebody decides to set up a business and adopt a particular name for use in that business, but they haven't formed any other entity or anything like that. It doesn't have any liability protection. It's a disregarded entity for tax purposes. It's really just using a fictitious name to do business. So we'll talk a little bit about that in the context of how they fit in with some of these other vehicles. But again, these days we don't see many people operating as sole proprietors if they want any sort of liability protection. So limited liability company, what is it? A limited liability company is an entity that is a creature of state law. All states at this point have limited liability company statutes. If you're going to form a limited liability company, you have to look to the particular state where you want to form it to see what the statute requires you to provide. Very different. Some states require a lot of information. Some states, like Delaware, for example, require very limited information, a name and an address and a person who's authorized to sign documents, and really that's about it. So you need to pay particular attention to the state statute. Limited liability companies are fairly recent creation. They really started coming into play in the mid to late 90s with the states adopting limited liability company statutes. Some states had the statutes prior to that. I think Wyoming was the first in the mid-70s, but they weren't really heavily used. Everybody looks to the big commercial states like Delaware and New York and California, and theirs didn't come into play until the mid-90s. And so there are some downsides with that. They don't have the long courtroom history, if you will, the long history of precedent and case decisions like corporations do. So there is still a little bit of uncertainty out there about how limited liability companies may be handled in a particular circumstance, because not all, a lot of cases involving different aspects haven't made it all the way through the court system yet. And the nice thing about limited liability companies, when it's the right situation, you really can get the best of both worlds between a partnership and a corporation. You can get the limited liability protection, you can get the pass-through taxation, but you can also have owner participation with which you can't have with some forms of partnerships. When you have an LLC, very, very commonly the owners are called members, and the people who run the business on a day-to-day level, the people who are signing checks, who are ordering supplies, who are scheduling employees, etc., they're called managers. Now, you can vary these terms in an operating agreement, but by and large, people will use the terms members and managers to refer to the owners and the operators. And you can have someone who is both. You can have a member manager, a person who owns membership interests in the LLC and is also running the business. In order to form a multi-member LLC, if you have more than one member, you have to have an operating agreement. You have to have a governing document, and that governing document is typically called an operating agreement. There are other names that are used, but very frequently people will refer to it as an operating agreement. And when it's set up properly, an LLC can do all the things that a corporation can do. They can transact business, they can own real estate, they can hire employees, they can have employees, they can make investments, all sorts of things, the same broad range of activities that a corporation can do.
One interesting difference, though, with an LLC, you say that an LLC can have employees, and of course it can, but the owners of an LLC, the members, are not employees for tax purposes. Mm-hmm. The government's litigating position is that owners of an LLC taxed as a partnership are partners, not employees. That means that they don't receive W-2s, there's no withholding, their earnings are reported on Schedules K-1, and there are some differences on fringe benefits. Mm-hmm. So there are some important differences here. Yep. Real estate is also an interesting one to point out a difference. LLCs, of course, can own real estate, and partnerships have historically been the preferred ownership vehicle for real estate. For tax purposes, owning real estate in an LLC makes a whole lot more sense than owning it in almost any other kind of entity, particularly S-corps and C-corps, which impose an entity-level tax, or in the case of S-corps, don't provide basis for related debt. So real estate and LLCs go hand in hand.
And actually, I'm going to pop back for 1 second on LLCs. One thing that's very important to remember, you cannot have an LLC unless you have actually made the proper filings to form the LLC. We have had people in the past who have come to us and said, well, I have people that I want to do business with, and we've signed this operating agreement, and we have an LLC. Actually, you don't. You don't have an LLC. What you probably have is some form of a partnership, maybe a general partnership, which you never want to be in. But until you actually file your certificate of formation and get confirmation from the state that you're formed as an LLC, you do not have a valid and effective limited liability company, even if you have a signed operating agreement among the parties. So we'll talk a little bit about corporations. They're also a creature of state law. You can't have a valid corporation until you have filed whatever it's called in your state. It could be a certificate of formation, articles of incorporation, certificate of organization, but you can't have a valid corporation until you make that filing and until the state confirms that you have a valid and effective corporation. One of the reasons that many people, in particular institutional investors, prefer corporations is that there is a long history of litigation involving corporations, and there is some fairly well settled case law about, for example, what directors can and can't do and what powers stockholders have and things like that. It does change from time to time, but by and large, corporations have the most well settled body of case law of really all of the relevant business entities. When you have a corporate entity, the owners are called shareholders or stockholders. The terms are used somewhat interchangeably. And the people who are running the business on a day-to-day basis are frequently referred to as officers. So the president or the CEO, the treasurer, the CFO, people like that, they are the officers of the corporation. And some states will have specific offices that have to be filed. You have to designate a principal executive officer or a principal financial officer. But some states give you great flexibility to have whatever officers you would like, and you set those in the bylaws or by stockholder vote. Corporations also have directors. Directors are elected by the stockholders, and they oversee the big picture of the corporation. So in large public corporate entities, for example, the directors will decide whether or not the company is going to spin off a line of business or whether they're going to make a very large acquisition, things like that. In smaller companies, the directors, it scales, and so they are responsible for the bigger picture activities of the corporation, even though they might not be as big as you would see with some of the public companies. But if it's material to the corporation, if it involves a significant amount of money or pledging all of the corporation's assets, even though there's not a lot of them, for a bank loan or something like that, then the directors have to be involved, and the directors need to approve those sorts of things. The governing documents for a corporation are typically include articles and bylaws, or certificate of incorporation and bylaws. In Massachusetts, it's articles. In Delaware, it's a certificate. So apologies if I go back and forth with the two names, but some form of formation document and the bylaws. The initial formation document that you have to file with the state is usually pretty simple. When we get to the formation piece in this presentation, there's a sample of a certificate of incorporation for Delaware attached, and you'll see it's not a lot of information. But as a corporation maybe takes on venture capital investment or private equity investment, the charters become very, very complicated, and sometimes they're 15, 20 pages long and have all sorts of provisions in them that you don't need when you're just initially setting up a corporation for basic liability protection purposes. And again, a little bit of a summary of what the corporation is. It's an artificial person that is authorized by state law to carry on business, conduct business, can sue, can be sued, can own real estate, can sell shares to raise capital unless it's a nonprofit, can do all these things, but only as authorized by state law. And as you'll see under the Internal Revenue Code, there are a number of other things that are treated as corporations as well. So some associations, joint stock companies, insurance companies, they are treated under the code for tax purposes as corporations as well.
And what we're going to see later is that under certain circumstances, a limited liability company, which would ordinarily be taxed as a partnership, can elect to be taxed as a corporation.
Mm-hmm. Mm-hmm. We're going to talk a little bit now about partnerships. And partnerships are a little different than both corporations and LLCs. Partnerships have some state law elements. So, for example, if you want to form a limited partnership, which does provide some liability protection, you have to look to the state statute of the applicable state and file whatever is required to form that limited partnership. But there are also things that are called general partnerships, and those have a basis in common law. General partnerships are really just an association of people who are working together but who don't have some other form of entity. And there are fairly long lines in all states of decisions where the courts have said, well, if they're all working toward a common purpose and they have the same economic interest, then they are partners. And some aspects of partnership law will apply, like the duty of fair dealing and things like that. General partnerships are not a good thing, because general partnerships bring to the owners general liability, meaning everybody can be liable for the debts and obligations of the partnership. Limited partnerships, on the other hand, provide liability protection for the limited partners. The general partner will have general liability, but very often we use a corporate entity as the general partner or some other entity as the general partner in order to really limit any liability at that level. And then, again, for certain types of partnerships, there are state law requirements that have to be fulfilled in order to have a valid or effective partnership. If you don't do those things, then you will default back into a general partnership, which obviously is not the place that you want to be.
We have a question. It speaks to an area that we're going to talk to in more detail later, but the question is, what's the difference between a single member LLC and a disregarded entity for tax purposes? How is the single member taxed in relation to the LLC profits and losses on the individual's taxes? Under I think every state statute, LLC statute, a limited liability company can have one member or more. For tax purposes, the difference is how it's treated and how the partner or owner is treated for tax purposes. A limited liability company with only one member is taxed as a sole proprietorship, meaning that the existence of the LLC solely for tax purposes is disregarded. All of the activity, income and expenses, gain and losses are reported directly on the owner's individual tax return. If the owner is an individual, that would be Schedule C of Form 1040. It's possible that a single member LLC is owned by another entity. If, for example, the single member LLC is owned by a corporation, then the income and loss, gain, expenses related to those activities would be reported on the corporation's Form 1120. It would be treated as a division.
So the bottom line, if you have a single member LLC, it's going to be a disregarded entity for tax purposes.
Unless there's an election made for it to be taxed as a corporation, and that we'll talk about further on.
Yep. Okay. So again, just to recap, with limited partnerships, if you have people who are working in concert with a common economic goal, you're going to have some form of a partnership. But unless you have done what you need to do in order to file and form an effective limited partnership or a limited liability partnership for professional organizations, you're going to default down into the general partnership category, which you really don't want to do. We're going to talk a little bit later when we get into the analysis of the different entities in different situations, why a limited partnership is really not a great vehicle for an operating business where the members, the owners, the people who own the interest in the limited partnership might be involved with the operation of the business. Do we have a question?
We have a follow-up question about the governance in a limited liability company. What is the equivalent body of a corporate board of directors in an LLC?
Now that's a very good question, and we will go into some more detail on the formation of the LLCs later on. But generally, the LLC is governed by what we call the managers. That's what the statute says, that the managers of the LLC make the decisions regarding the LLC. In some LLCs, the managers are the top level. In other words, they act as both the board of directors and the officers. So they make the decisions and they execute the decisions. In other LLCs, however, what you see is a very similar model to a corporate model. And you can set this up through your operating agreement, not necessarily in the way it's laid out in the state statute, but the statute gives you the flexibility to set it up however you want. So we have some LLCs that are set up with a very corporate model. In other words, the managers serve as a board of managers, so they're at the top level. They're the ones making the policy decisions and things like that. Then below them, they hire some people as officers, president, they can be the same, you can call them whatever you want, president, treasurer, grand poobah, whatever makes the most sense. And they run the business on a day-to-day basis. They function as the officers would in a corporation. So the bottom line for an LLC, you can do it either way. When we get into the drafting portion of the discussion, the exhibits that I've provided, I think there's one model that shows a corporate type model with a board and with separate officers, and then there's one that shows more of a partnership type model where the managers do everything. They're empowered to, buy real estate. They're empowered to hire and fire people, et cetera, et cetera.
Now, there is one other alternative. Most statutes permit a limited liability company to be member managed. That is to say, it doesn't have managers at all. It's managed by its members in a very sort of democratic way. We typically recommend that our LLCs appoint a manager, in part because you'll be dealing with banks and other institutions that expect to see a manager and worry whether or not a member, for example, is authorized to take a particular action. So while it isn't required under many statutes to have a manager-managed LLC, we find it's practical to do so.
That's right. That's a very good point. You do have some people who think it's a good idea to have a member-managed LLC where it would be the equivalent if a corporation didn't have any officers or directors, but the shareholders all got together and decided how things were going to be done. And for any number of reasons, that's probably not a good model.